So Leland was also curious. Kinder obviously kind of got overextended, and then they cut the dividend in order to focus on expanding everything. So he just asked, has the balance sheet been substantially deleveraged at this point? I have to think the answer is no. It's a little early, right?
No, it hasn't.
Yeah.
I mean, when you say when you have leverage on your balance sheet, it is there's a couple ways you can think about it, but I think the most common way is debt or EBITDA to or net debt to EBITDA. And a couple months ago, is when we started to see them focus on it, on deleveraging the balance sheet. And the really only way you can do that is cut debt or increase EBITDA. And there's
no way that's happened
in the market. You're certainly not seeing an increase in EBITDA from bringing on any new projects or anything like that. And they don't have that huge cash pile to pay down debt. So if neither of those things have really moved yet, then they're not really deleveraging. However, if you look at the way that they've made their dividend policy, they're on the path to do it.
Got it. So this gets a little bit more into, maybe for our listeners that don't know a ton about Kinder Morgan. But Lynn's next question is, are all their contracts to transport oil and gas rock solid so they'll meet or beat their 2016 revenue and cash flow numbers?
I don't have the
So what does Kinder do, and then what do you think about his question?
Well, I don't have the breakdown, but I would imagine that over 50% of their pipelines are filled with oil from some of the integrateds. I know like Enbridge is about 2/3 supplied by integrated. So when you're dealing with the amount of pipeline that you're dealing with Kinder Morgan,
it's hard not to deal with ExxonMobil.
My guess would have to be that Exxon, Chevron, all these guys are filling the pipes for the most part. So you're looking at pretty safe customer base. Like I said, I don't have that mix.
Well, you don't get as big as Kinder Morgan by just dealing with small players.
Yes, right, exactly.
So
I think EOG might be one of the smallest companies that they work with. Because other than that, who's going to move the needle for the kind of capacity that they're looking for?
Right.
And then they have oil and gas production assets. Not ultra meaningful in comparison, and then you have the fleet of ships that they bought last year. Was it 2014, where they have oil transportation ships. So they have smaller bits and pieces, but the bulk is the oil and natural gas transportation and terminaling, and you have to deal with integrateds to be as big as Kinder is.
Cool.
And I think maybe just the 1 weak spot where it might not have that rock solid coverage, just like you said, in the production side, they've got their CO2 carbon dioxide business where they're supplying carbon dioxide to producers who are looking to use that for enhanced oil production. And as we've seen over the past year or so, that has been kind of the declining spot of earnings and where the contracts aren't as robust. And so, if you're looking from a very, very large component of it, like 85, 90% of it is very, very strong, that little bit of 10% can be kind of a game changer. It certainly a while ago when they were paying out so much in terms of dividend, when you have a little bit of weakness, all of a sudden that dividend payment looks unsustainable. But now that they've got that much more wiggle room, it's not as bad.
Right.